Hi everybody, Dr. Wright here again. Recently in class we've been studying the subject of market efficiency. At the limit we could think of perfectly efficient markets. A perfectly efficient market would be one in which all relevant and material information is instantaneously and accurately impounded into the market prices. Now I don't think that anybody believes that there are any markets in existence that are perfectly efficient. So for practical purposes, we talk about three different levels of market efficiency: strong form, semi-strong form, and weak form market efficiency. Starting with the bottom level, weak form market efficiency, a market that is weak form efficient accurately and quickly impounds into the prices all material relevant information that is contained in past trading data. So this would be past prices, past returns, past volume. Any past trading data in a weak form efficient market is quickly and accurately impounded into the prices. Another way of thinking about this is to say that in markets that are weak form efficient, there would be no alphas that could be generated using a trading strategy based on past trading data. So that's weak form efficient. A semi-strong form efficient market is a market in which all publicly available information, including past trading data, but also including things such as press releases, news stories, analyst reports, and financial statements. All publicly available information is accurately and quickly impounded into prices. So another way of thinking about a semi-strong form efficient market is to say, in a market that is semi-strong form efficient, there would be no opportunities to generate alpha using trading strategies based on publicly available information. Markets that are strong form efficient are markets in which all known information, meaning all information contained in past trading data, all information that is publicly available, news stories, financial reports, press releases, analyst reports, but also inside information, information that exists and is known by a select few. In a strong form efficient market, all known information is impounded accurately and quickly into market prices. In short, we could say that in a strong form efficient market, there would be no opportunities to generate alpha regardless of any informational advantages that an individual might have. So we've been talking about these ideas of market efficiency and how efficient are the markets on this scale of weak versus semi-strong versus strong form. And then most recently what we've been discussing is the idea that there have been certain empirical findings that have cast doubt on the idea or the possibility of our markets being efficient. Specifically, we have discovered that there are certain trading strategies based on different types of information that do yield alpha or abnormal returns, and these things simply should not exist if markets were efficient. So the types of, and we call these findings, these empirical findings that seem to cast doubt on the efficiency of a market, we call these market anomalies because they are anomalistic relative to an efficient market. So I like to categorize market anomalies into three basic bins. The first category of market anomalies would be called calendar time anomalies. The second category would be firm characteristic anomalies, and the third category would be behavioral anomalies. It is not my objective in this video to review all of the market anomalies, all of those empirical findings that cast doubt on the efficiency of U.S. stock markets. My objective in this particular video is to review simply a handful of what I call the calendar time anomalies. Primarily, I want to show you how you can calculate some of these anomalies in Excel. I'm also hoping to improve some of your Excel skills. And so really what I want to focus on today is how you could quickly reveal to your own eyes some of these calendar time anomalies, specifically the Monday effect, the January effect, the holiday effect, and the October through March seasonality market anomaly. So what I want to do is I want to download some data into Excel, and I want to show you that returns to our stock market on Mondays are much lower than the other days of the week. I want to demonstrate to you that stock returns are generally higher during the first few days of January than they are during any other days of the year. I want to show you that stock returns to the days immediately preceding holidays are higher than any other days of the year. And I want to show you that the lion's share of the returns in the stock market are realized during the months of October through March. Before I actually get into the data, it's important to understand that there's no way to explain these variables in an efficient markets framework. Take, for instance, the Monday effect, which is the finding, rather consistent finding I might add, that stock returns are lower on Mondays than they are on Fridays or the other days of the week. In order to explain that in an efficient markets hypothesis framework, one would have to make the argument that somehow stocks are riskier on average on Monday than they are on any other day of the week. That's, of course, hard to defend with any sort of clear intuition, and so we refer to it simply as a market anomaly. It does not make sense. It's inconsistent or incongruent with an efficient market. So let's go ahead and get some data and see if we can take a peek at these things ourselves. I'm going to go ahead and use a file again that has a macro in it that will allow us to scrape Yahoo Finance to bring in daily data. This is slightly different than the file that we used previously. The file that we used previously brought in monthly data. We want daily data for this particular assignment. So this is a new file, and again it's attached to the assignment on Learning Suite. So pull up the file, and then what we're going to do is we're simply going to pull in data for the S&P 500 going back to 1960. Now, I want to show you something in Yahoo Finance. If you click on the S&P 500, it appears that the ticker symbol that you need to use in order to obtain data for the S&P 500 is right there. However, using the caret and GSPC does not work. Let me show you what you actually need to use. If you click on historical prices, up here at the top, you can see this S equals %5E GSPC. That's actually the ticker symbol that you need to use. So you need to copy just that right there and bring that over to your Excel file and put it in as the ticker symbol. Put in the date range that you'd like to use. We'll go from 1960 to 2012. Through June 30th of 2012 at least. Go and view the macro, and you can see there should only be one macro that's available. Run that macro and it will pull in this data, and then I would immediately save that so that you don't change the template for the macro. So let me just save that really quickly here. Okay, so I've saved my file, and all I want to do is work with this data here. So the first thing I'm going to do is sort it as we've done in previous assignments based on date from oldest to newest. Don't really need any of that data right there, so I'm going to get rid of it. I'm going to calculate the returns using continuously compounded returns as we have done in previous assignments. So it's the natural log of the ratio of today's price divided by yesterday's price. Send that all the way down. Turn it into a percent. Now this is daily data, so we expect it to be relatively small, which it is, you can see. Now, what I want to be able to do is I want to be able to show you the Monday effect. I want to be able to show you the January effect. I want to be able to show you the holiday effect. So what we're going to need is we're going to need months and days of the week as well. So we're going to do this. We're going to get the year from all of these dates. Don't worry about that. That's a formatting issue. If you just format it as a general number, you'll see it's the year. We're going to get the month. We're going to get the day of the month, and we're going to get the weekday, which will tell us Monday, Tuesday, Wednesday, Thursday, Friday. So let's get the month using the simple month formula. So there's that. Let's get the day using the day formula. All right, and we want to get weekday using that formula right there. And we might be inclined, well, first off, let's shoot all those all the way down, and then let's just center all of this for our purposes. Now, I would recommend, simply because you might run into some formula obstacles later on, I would recommend replacing all of these cells right here. Replace the formulas with just the numbers. So I'm going to highlight all of that data. I'm going to copy it, and then I'm going to paste special values. So right click, paste special, and values. That replaces all the formulas with the simple numbers, and that's going to prevent us from running into some problems later on. Okay, now that we have this, we're actually prepared to analyze and search for some of these market anomalies. Before we do that, let's go ahead and set expectations. So average returns, let's do this on a daily basis and an annual basis for the full sample. So let's just get the average daily return. And usually there's about 250 trading days per year, so if you multiply that by 250, that will give you, over this sample period, the average annual return. Might want to center that, although I see a typing error there. So might want to center that as well. Just doing a little formatting here, nothing to get worked up about. So this becomes our baseline for what we're going to compare things to. So now what we want to do is we want to see if there truly is a Monday effect, see if there's a holiday effect, see if there's a January effect, and see if there is an October through March seasonality effect. So let's start with a Monday effect. And let's do this. Let's do day of the week, and let's do it this way. Let's do day of the week, let's do the daily return, and let's do the annual return. So days of the week, we have 2, 3, 4, 5, 6, which translates to Monday, Tuesday, Wednesday, Thursday, Friday. So what we're going to do is we're going to use an average ifs function. So this is how it works. Average ifs. And the first thing that it wants is the average range. So what we're going to do is we're ultimately going to do an average from this column. The next element that it asks for is a criteria range. The criteria range is going to be our weekday. And specifically for Monday, we only want to take the average from this column, the returns, if the weekday is number 2, because that represents Monday. So I'm going to highlight that whole column, which is our criteria range. Then the next thing we have to tell it is the criteria. Put this inside quotation marks, equals, and then we have to give it the ampersand, and we're going to say 2. And 2 is the number that's actually located right here in cell K6. So I'm going to say K6. Now, we make it a percent. There's the daily. Let's annualize it, which is that. Now remember, there are 52 weeks in a year. So if we have only Mondays that we're looking at, then to get the average annual return on Mondays, let's multiply that by 52. So just focusing on Mondays, we can see that the average return each year is about 3.128%. Now let me just show you that formula one more time. So what we're saying is, from the G column, we're going to take an average, but only if all of the numbers in the E column, which is our weekday, equal whatever number is in K2, which is the number 2 representing Monday. We can do a slight tweak to this formula, and we can just copy it down. Let's do absolute reference for the G column, absolute reference for the E column, and do that. And now if we slide the formula down, you can see what happens to it. Everything stays the same, except for now we're not referencing K6, we're referencing K7. So we can slide that formula down as well. We should be able to slide those formulas all the way down. Double click and maybe format this. And we could do something like this, day of the week, or we could say weekday. And we could center that across like we've done before. Again, nothing special going on here. And we might just give it some formatting like I like to do. You've seen my style. You pick a style that works for you. All right, so do we see a Monday effect going back to 1960? Well, we do in fact very clearly see a Monday effect. Now you can remember the average daily return for our whole sample is 0.024%, and per year that translates into 5.91%. On Monday, the average return is negative 6 basis points. So if you consider there are 52 Mondays in a year, then the average annual return is minus 3.128%. Now, if you wanted to get technical, there are really only 50 Mondays in a trading year because Memorial Day and Labor Day. So I don't mind if you go ahead and peel off 50, right? And you could go through and you could say, all right, there's only actually 51 Thursdays in a typical year because we get a Thanksgiving break. I don't mind if you make that adjustment. That works for me. Okay, and you can see that by doing that, we get very close. If we just add those up, we get very close to what our average annual returns are. Now keep in mind, you have a couple other holidays. You have July 4th, you have New Year's Day, you have Christmas. So those are going to chop out some days, but those days are going to be moving targets. It could be a Monday, it could be a Wednesday, it could be a Thursday. So we can't bake those into the analysis, but we can bake in Labor Day and Memorial Day into the Mondays, and we can certainly bake in Thanksgiving into the Thursdays. So I don't know how to demonstrate this to you any more clearly other than to show you that every other day of the week is giving us a positive daily return. If you annualize it, it's somewhere between 1 and 3.5%. For some reason, Wednesdays look really good, but Monday sticks out and definitely is noticeable. And so absolutely, we see evidence of a Monday effect. So check mark on the Monday effect. All right, next we want to analyze the January effect. Now remember, the January effect suggests that stocks have unusually high returns the first few days of January. We have actually refined the January effect, and now we know that generally speaking, it is the returns to small stocks that have performed poorly over the previous year. Those stocks in particular have very significant pops, positive returns in the first few days of January. But the anomaly generally holds even if you look at just general stock market data, that you'll see that stocks have higher returns the first few days in January than they have over the rest of the year. So let's just do this. Let's do December. Why don't we do December like 28th, December 29th, December 30th, December 31st, and then let's do January 2nd, January 3rd, January 4th, and January 5th. We anticipate, if there is a January effect, that the returns to these 2 or 3 days right here should be exceptionally high relative to the other days. Now, I would add one caveat. We're also mixing anomalies here because we're capturing the holiday effect. Remember, there is an anomaly, the holiday effect, that has demonstrated that stocks have high returns the day right before a holiday. So don't be surprised if we see a high return right there and then the January effect right there, but nothing special necessarily right there or right there. So let's use our average ifs function. Again, we go to the G column, and this time we're going to have two criteria. Our first criteria is going to be in the month column right there. In particular, we want that month to be equal to whatever we have. We want that month to be equal to, remember you have to put an ampersand, sorry I forgot that, equal to that month, but we also want the day equal to this day. So let's also highlight the day column. Remember to put the equal sign inside quotation marks, and you have to include an ampersand like so. And that's the average daily return to stocks on December 28th over our sample period. Now, let's annualize that. So that's a daily return. So if you earned that every day of the year, then multiply that by 250 trading days, like so. Now let's make our absolute reference changes here. So absolute reference in the G column, absolute reference in the C column, also in the D column. and that should do the trick. We should be able to slide these formulas down. Just remembered that I want to scoot this down a little bit, so let me scoot that down so I can put labels. So again, this is daily returns, this is annual returns, this is now month, and this is now day. Center that. And let's take a peek at what we see. As we suspected, we definitely see the holiday effect. Effectively, in the 3 days leading up to the New Year's Eve holiday, we see extremely high returns, but we definitely also see the January effect. So in the first few days of January, we see a significant pop in stock prices. Now, what's my reason for saying this? Look at average daily returns over our whole sample. So the average daily return to our whole sample is 2.4 basis points, which translates to 5.91% on an annual basis. In the first 2 days of January, we get 23 and 19 basis points respectively, which translate into 58 and 48% on an annual basis if you could get those returns every day of the year, which obviously you can't. So clearly, again, we have to conclude that we are in fact seeing a January effect. Let's highlight it right there. Now, why don't we pause right here and just remind ourselves, there is no good explanation that you can offer in an efficient markets framework that will explain that. There's no justifiable reason why stocks, if markets are efficient, should have significantly higher returns on January 2nd and 3rd than they do on the other days of the year. You would have to make the argument that somehow the stocks are riskier on those 2 days, and I don't see any way that you can justify that. So we have to conclude January effect, check mark. All right, next thing we want to do is the holiday effect. So let's do the holidays that we can lock down. So let's do the month and the day. So specifically, let's do July 3rd, let's do December 24th, and let's do December 31st. Now, the reason I'm doing July 3rd, December 24th, and December 31st is because the markets are closed every year on July 4th, December 25th, and January 1st. So these are days that precede market closings because of holidays. You could throw other holidays in, but they would have to be on the same day every year. In other words, you couldn't do Memorial Day, you couldn't do Labor Day using this analysis because you would have to actually go through and pick out. You could do a flag variable, like you could go through and figure out exactly which days were Memorial Day and Labor Day, and then you could do it. But there is one other holiday that we could throw in. The markets don't close, but you never know. So let's do February 13th because the next day is Valentine's Day. Again, I don't know if there's going to be that. Look, the markets aren't closed. This generally, the holiday effect applies to holidays that close the market, but we can check anyways. So we're going to do the same thing that we did up here. In fact, we can just copy that formula and paste it down. And paste it down and down. And we can also just, again, multiply that by 250. And get the right format on that. And format this like so. Okay, so we're asking ourselves, do we see a holiday effect? Remember, the holiday effect is the empirical finding that stock returns are abnormally high the day before holidays, specifically when the markets close. Well, it's quite apparent that, in fact, there is a holiday effect. You can see it very clearly, focusing specifically on these 3 days. The day before July 4th, we get huge stock returns. The day before Christmas, we get similarly impressive returns. And the day before New Year's Eve, we also get really high returns, especially if you compare that to the overall sample. Interestingly enough, we also get really positive returns on February 13th. Now, I am curious, February 14th, the market should be open, so maybe the holiday effect should be on the 14th, not the 13th. We do not, in fact, really see anything impressive there. So For some reason, it's the day before the holidays. So this all would have to be highlighted as evidence of the holiday effect. All right, so we have seen the Monday effect. We have seen the January effect. We have seen the holiday effect. The last calendar time anomaly I would like to demonstrate to you is the October through March seasonality effect, which suggests quite simply that the lion's share of the returns in the stock market occur between the months of October and March. In order to demonstrate the October through March seasonality effect, we need to figure out the returns in each of the months, which is straightforward. All I'm going to do, though, is I'm going to start with October, then we'll do November, then December, then we'll go February, March, on down through September, like so. We'll use the average ifs function again. We go to the G column. This time the criteria range is in the C column. And remember to put the criteria in quotation marks with an ampersand. And we're going to want it to be the month that is in cell P6. Now that's the average daily return for all of the Octobers in our sample. If you could get that every day of the year, so multiply that by 250, it would look like that. Center it. Go in and do your absolute references in the G column and in the C column. Maybe give it one more decimal place. Shoot those formulas all the way down. Give it just a little bit of formatting help. Now, let's just do something to make it super clear, although this isn't technically statistically a great thing to do. But let's do October through March. And let's do April through September. So let's just take the average. Again, this isn't technically statistically correct. This is a back of the envelope type calculation. But we'll get away with it for now. So we can see that in the months from October through March, the average daily return is about 4.2 basis points, which is double the overall sample average. If we could earn that every day of the year, we would get 10.5%. Contrast that with months April through September. The average daily return is a half of a basis point. That annualizes to 1.196%. It's incredibly clear from this that there is, in fact, an October through March seasonality effect. So you've seen the Monday effect, you've seen the January effect, you've seen the holiday effect, and I've just demonstrated to you the October through March seasonality anomaly. The last thing I would like to do is show you an alternative Excel method to arriving at essentially these same results. I'm only going to demonstrate this for one of the anomalies. I believe if I demonstrate it to you for one of the anomalies, you would see how you could change it for the other anomalies. What we're going to do is insert a pivot table. So go to pivot table and then select your data range. And what we're going to do is we're going to select all of this data right up here, starting with year all the way down to the bottom, and we're going to put this on a new worksheet. And what I'm going to show you is the holiday effect. So here's how a pivot table works. Really quite extraordinary. What I want to do is I want to put the days of the week right here as the rows. And I want to put the month as the columns. And then I want to put the return as the content of the table. Now, what this is showing you is how many returns we have. So this is the number of observations. In other words, we have 39 observations on February 1st, because these are months, these are days. We have 28 observations on January 2nd. I don't really want to know the number of observations. What I want to know is I want to know what the average return is. So go right here to value field setting and go to average. Click OK and then get out of that. Now we want to format this as percentages. And we could shrink this down a little bit so it's a little bit tighter on the screen. Now you can see we don't have any data on January 1st because that's a holiday. We have no data on July 4th and no data on December 25th. So January 1st, July 4th, and December 25th. We have no data because those are holidays, the markets are closed. So we could look at this and we could easily identify the holiday effect. Now notice that right there represents the overall daily average. So on average, each day of our sample, we earned 2.36 basis points per day. You can also see a little bit of the the October through March seasonality effect. Here's the average returns, average daily returns of October through March right there. So you could see the October through March seasonality effect right there. But what I'm concentrating on right now is the holiday effect. So I want to focus on the days before the holidays. So I want to focus on January 3rd. I want to focus on December 24th. And I want to focus on December 31st. And you can see these are in fact much higher than the overall average. In fact, the worst of those is December 31st, which is still almost 4 times, we'll call it 3.5 times the overall sample average. So very clearly we can see the holiday effect here. It's easy enough to show you how to do the day of the week effect. So let me just go back into my fields. Now I don't want the month and I don't want the day. What I want is the weekday. Get rid of that. And now what do we have right here? Monday, Tuesday, Wednesday, Thursday, Friday. We can see the overall daily average, which you saw when I did the pivot table earlier. Overall sample average 2.36 basis points. Look at how terrible Monday is. And again, these results are consistent with what we did over here. You can see the average daily return on Monday is negative 6 basis points. We get the exact same outcome using the pivot table. So all I'm trying to show you is two different methods to get you the same results. Since we're here, it doesn't hurt us to play around with it a little bit more. Why don't we do January effect? So let's put month back as the column. Let's get rid of weekday. Let's put back in day of the month. There it is. Come back over here and you can see the January effect is right there. There's the first 2 days in January. Considerably higher than the overall average. We could easily do the October through March seasonality effect a little more clearly. Get rid of those. Just put month in the row. And you can see quite clearly that October through March is a lot higher than the overall average. And you could even do this. You could say, all right, just show me October through March. So get rid of April through September. And you can see that the average daily return of October through March is 4.26 basis points, which is much higher than the overall 2.36 basis points. But when you turn it in, I would like you to show me the holiday effect. So let's put month in the column. Let's put the day in the row like we did previously. Go ahead and black out the holidays where we have no data. And highlight the days right before the holidays. And feel free, if you're so inclined, to also highlight the day before Valentine's Day, since that's a consistent day every year, so we can do that one. You can clearly see if you take the average of those 4 days before holidays, the average is 17.14 basis points, which is considerably higher than 2.36 basis points. So when you turn this in, I'd like to see a table that looks like this. that shows me these 4 calendar time market anomalies using the average ifs functions. And I would like a pivot table showing me the holiday effect, which should be very, very similar to what you're demonstrating over here. In fact, it's probably worth just showing you that it is. If you look at, for instance, the holiday effect, we should have labeled this, shouldn't we? Let's take a minute to just do that. Down, you go down, and you go down. So this is the holiday effect. This is the January effect. This is the Monday effect. And this is the October through March seasonality. So when you turn it in, I would like it labeled like this. So these are all the average ifs functions. Give me a pivot table that shows me the holiday effect. Just to make sure we did it right, the pivot table says that the average daily return on December 24th is 16.8 basis points. We show over here that the average return on December 24th is 16.8 basis points. So you can in fact see you get the exact same results. 2 different ways to get there. I do want you to practice pivot tables because hopefully you could see just from what I was doing, very quick, very effective way to parse and slice data. If you have any questions, feel free to contact me or the TAs. Best of luck with the assignment.